Good day and welcome to another one of our Macro Insights discussions hosted by Satrix in collaboration with BlackRock's iShares. We are absolutely delighted to have our fan favorites back with us. Laura Cooper, certainly no stranger to our audience. She is the Senior Investment Strategist for iShares by BlackRock. And we also have Omar Moufti. Welcome. Thematic and Sectors Product Specialist at BlackRock's iShares. Welcome to you both and thanks for joining us. We're looking forward to having a nice, robust discussion around all things macro, thematic, and the like. Laura, I want to start with you. And before we get stuck into the detail, I'd like to take a step back and unpack the asset allocation trends you saw play out in 2023 and which of those trends have remained sticky going into 2024. And perhaps if you can also unpack which of these themes provide short-term tactical opportunities and which of them are the longer-term trends that you see playing out over the next few years.
Well, there have been some really interesting trends looking back at 2023. I think one that stands out across the global ETF landscape is we saw a record year of inflows for fixed income. But beneath the surface, there was a bit of a rotation in the sense that we did see rates accompany about most of this through the first three quarters. And then we saw this risk-on sentiment really become more pronounced in Q4. And that's where we saw credit inflows rise quite sharply. And that's a trend that's actually persisted looking into so far this year. And we think that's probably more of a tactical opportunity, just trying to capture this high yielding type of environment before central banks start to cut their policy rates across developed markets later this year. Another interesting trend that emerged was around US equity buying. So in December, it was actually a record month of buying across US equities. And this was largely driven by tech sector buying, perhaps unsurprisingly, looking at what's happening in the markets. But this we see as more of a strategic long-term trend because it's underpinned by artificial intelligence. We really think that that's going to be a mega force that will continue to kind of be on investors' radar for some time to come. And then perhaps the third trend is what we saw from an inflation perspective. So last year was a record outflow year for fixed income inflation-linked bonds. And so that's a trend that, again, we're also seeing persist year to date. But on a strategic basis, we're actually leaning against that because we are in this inflationary regime where we think investors are going to seek greater protection for elevated price pressures. So perhaps we could see a shift in that trend over the medium term.
Fascinating. Thank you, Laura. So the last time we spoke, we were talking about some form of landing in the US economy on the back of tight monetary conditions 2022 and 2023, with the consensus being at the time that an economic landing was due in 2023. Now, as it turned out, there was no landing in the US economy, and the US economy has kept flying, with job numbers continuing to surprise on the upside and the US economy surging very strongly. Now, where do you see the likelihood currently, from your current vantage point, of the US market slowing down this year?
So we are still subscribing to this soft landing narrative. Certainly, we're continuing to see the resiliency in U.S. economic data, and that's a trend that, yes, can persist, but we do think there's going to be greater signs of moderation, and that's largely expected to come from a slowdown in the consumer. I think we're already starting to see pockets of stress there, but we don't expect to see a catalyst that would trigger a hard landing or a deep recession in the US. And so kind of from a markets perspective, we think that the backdrop is still supportive for a broad risk-on sentiment to be supported. And perhaps, if we look at what's happening from the Federal Reserve, rate cuts in the pipeline later this year, I think will be a key component of that. The key risk, though, is if we start to see an upswing in price pressures later this year, and that could in turn lead to this higher for longer rates backdrop persisting for even longer, and that is when we would probably see a rising tail risk of a recession, but certainly probably not a story for this year.
So I think paradoxically, it seems that the worst case for the market is if the US economy keeps growing strongly, and so what's best for the market is actually worse for the economy and vice versa. So there's this inherent paradox there. And would you agree with that? And I mean, when will this disconnect, if you like, between the real economy and interest rates, how will this play out? I mean, when will this change, if you like?
Well, I think it has been interesting in the sense that good news could potentially be bad news for financial markets because it's all really predicated on what the Federal Reserve does. I think certainly we have seen markets quite resilient to the recent rates repricing. I mean, if we look back only a couple of months ago at the start of the year, markets were pricing in close to 6 rate cuts from the Fed. We have seen them pare back to around that 3-cut mark now, but equity markets continue to kind of test record highs. And so I think that will be the risk is if we start to see that the Fed push back even more to such an extent that we potentially don't see rate cuts this year, this higher for longer backdrop will certainly start to weigh more materially on economic activity, on consumer spending, some of those interest rate sensitive sectors of the economy that have been resilient, I would expect to come under greater pressure. So that's really the key risk that we are watching for. But as of now, our base case continues to be that the Fed will be data dependent. The moderation in data should support an easing cycle beginning probably in the middle of this year.
So critics have pointed to the Fed maybe being a bit myopic in terms of their data dependence, and they should, consider it a bit more broadly, the impact potentially on the real economy. Now, with elections being a major theme in 2024 as well, I read a stat the other day about what percentage of the world is actually voting this year, and it's fascinating. So elections is a really important theme going into 2024, and I wonder if you could perhaps touch on your views around the sustainability of sovereign and corporate credit debt at current interest rate levels, and the impact that this could have on further fiscal spending and tax cuts going into an election season. The UK recently announced significant personal income tax cuts, perhaps making it more attractive for voters to turn out in their favor. While the possibility, of course, of a second Trump presidency would almost certainly see similar strain on the US fiscus through tax cuts. Now, how do you see this playing out this year? And is there perhaps a debt trap lurking if rates remain elevated? And we're seeing that the debt servicing costs have skyrocketed in a lot of these developed markets. So how do you see this playing out this year?
Actually, yeah, that's a great question. I think pointing to what we mentioned about elections, so more than half of the world's population is actually headed to the polls this year. And we see this as one of kind of the key underpinnings of our megaforce around geopolitical fragmentation, just the uncertainty that comes from that backdrop. But as you mentioned around kind of the public debt loads, I think it's been very interesting because clearly we've been in this period of fiscal stimulus has been, quite supportive for overall economic activity across developed markets. But now public debt will come back into the purview of investors. And it's one of the reasons why we're actually neutral positioning on our government bonds and our strategic asset allocation, because we think investors will demand higher term premium to compensate for the growing risk that comes alongside these elevated debt levels. So in particular in the US, that is something that we do expect yields, on that longer term basis do have scope to rise even further. Because a negative term premium right now, we think is not sustainable. So I would suspect that we are going to be this higher yielding type of environment for quite some time to come on the back of these elevated debt loads.
Interesting. Omar, I want to bring you in next. Now, we've been hearing a lot about, and Laura's references a few times, about mega trends in recent years. And the BlackRock research team last year changed their views on trends slightly and rephrased it. So could you maybe bring us up to speed with your house views around the main forces shaping the investment landscape and also where thematic investments fits into this?
Sure, absolutely. So I wouldn't say that we necessarily changed our views. What we did was sort of update our mega force framework, updating it from something that we'd created in 2016. And in those 7 years, a lot has changed in the world. And so we rejuvenated our views of what are the big structural forces that are going to shape our society, shape our economy, and impact, of course, the companies that are operating within it. I think what is different this time around, and what's interesting, is previously the mega trend framework was something devised by us in the thematic space, whereas this update comes from our macro institute. And I think that is acknowledgement that these mega forces are not just impacting thematic returns, they impact equity market returns. And that's something we've seen in the last few years, most spectacularly perhaps in the last 15 months, where AI has not just driven the returns of a small pool of the market, but actually has driven the market forward, has led the market upwards. So we think that the next decade of investment is going to be shaped by demographic divergence, digital disruption and AI, geopolitical fragmentation, the future of finance, and of course the transition to a low carbon economy. I think what's interesting is that we are at a crossroads today. You know, the last of the baby boom generation is now reaching retirement age, and we have the over 65s being the fastest growing population cohort. It's important to be leaning into these trends. And I think what's interesting as well is that it is a balance between risk and opportunities. And thematic investment is about leaning into the opportunities that these megaforce framework affords us and investing for the future.
So what I find interesting about thematic investing is that it gives investors the ability to relate to their investments in a way that they couldn't do in the past using traditional investment vehicles. If you think, for example, of a typical global equity unit trust fund, while it will likely be well diversified across companies and themes, it might leave investors wanting to know, what exactly am I investing in? And so with thematic investing, investors have more transparency into what themes they are investing in and can decide for themselves whether it aligns with their own core beliefs or whether or their own investment goals in a way. Would you agree with that?
Yeah, absolutely. I think that has been one of the key drivers of the growth that we've seen in assets in the thematic investing space. In fact, thematic investing has been one of the fastest growing segments of the equity asset management universe. Clearly, we know that investing is good. Investing for your retirement is very important, and it's incumbent upon the asset management industry to deliver products that are relatable. You know, ultimately, our end investors are consumers, and consumers need to understand what they're buying into. And I think thematics are key to helping financial products be also good consumer products. Now, that isn't to say that it's just about narrative or branding. Behind the scenes, there's a lot of work done from the asset manager, in our case, from BlackRock and iShares, to develop themes that we think are robust and that are tapping into this long-term opportunity set, both in terms of selecting the themes, but also constructing the indices and the investment process behind this that help to deliver on that long-term opportunity.
Especially with a new generation of investors coming to the fore, that highly priced transparency in terms of all the products that they consume. They want to know what they eat, they want to know what they drink. And so knowing what you invest in at a deeper level makes sense, right, for a new generation of investors.
Yeah, absolutely. I think understanding is key to keeping investors invested really over the long term. I think what's interesting about thematics is the potential to look past the near-term volatility, the near-term uncertainty, whether it's interest rates, growth cycles, PMIs, whatever those short-term macro indicators that investors may be looking at, and focus on that long-term opportunity set. Because almost, counterintuitively, oftentimes the long term is possibly more certain than the near term. And I think thematics are key to helping investors keep that long-term vision in their long-term portfolio.
Keep an eye on the prize and align with your own investment goals. I like that. Now, what themes would you say investors found most appealing, considering the myriad of challenges we're seeing in South Africa, globally? I mean, what type of themes are resonating with investors currently?
Absolutely. So I mean, following up on what we said previously, what we've seen is that flows have really tracked real world developments. So in 2020, 2021, when we had the COVID shutdowns, flows went towards these digital acceleration themes, whether it's e-commerce or video conferencing related themes. At the same time, there were a lot of policies put in place on climate technologies. Flows also went there. In 2022, which was a very difficult year for the asset management industry, reflecting the geopolitical insecurities that we were living through, flows went towards themes around energy security, food security. So this is how clients have been able to implement real world events into their portfolios. And the last 18 months, I would say, have been focused on tech and AI related themes. Now, clearly, that is what has driven markets recently, but going forward, there are other themes that are going to be attractive. So it's important to keep a wide scope. I think one that's very interesting, you mentioned the local environment in South Africa. I think infrastructure is very much something that is relevant to what is occurring here in South Africa, much like the many other places of the world.
And Laura, I want to return to you, and I want to get your sense for what is keeping you up at night. And I know this is a question that's oftentimes asked on panels, what uncertainty do you see? But is there a specific theme or an element? We've touched on themes and we've touched on many of these macro developments, but what part of what looking ahead for the year and maybe into next year even, what is there that's potentially on the horizon that investors should be cautious for looking ahead?
I think there are probably two clear risks that come to mind that do keep me potentially up at night. I think the first is around geopolitical fragmentation, because we are in this kind of world of heightened uncertainty around certain relationships and whether that could actually feed into this ongoing rewiring of supply chains, which in and of itself is inflationary. And that leads to the second clear risk, and I think that's around inflation. The fact that investors are essentially just kind of extrapolating this disinflationary trend out throughout the forecast horizon. There's this great deal of certainty that we're going back to 2% targets across developed markets. There is a risk that we could actually see a reacceleration of price pressures later this year, predominantly in the US, if we don't see that goods disinflation persist, but instead it actually settles at a level above what we saw before the pandemic. So I think that just alongside a lot of these long-term structural forces that Omar mentioned, does in itself lead to this new inflationary type of regime, which does suggest investors do need to have a greater degree of caution around that risk, because the implications from a central bank perspective are that they could actually keep rates higher for longer or not have the kind of aggressive easing cycles that we saw previously. So markets essentially have to get used to a new macro regime of elevated inflation and higher for longer rates.
So with gold recently hitting all-time highs, with duration risk clearly remaining in bonds, with equities having run hard, what is the protection ballast in a portfolio these days?
Well, I think there's probably two ways of looking at this. One, you did mention gold testing those record highs. I think that's largely reflective of the fact that investors still see that as a hedge against those tail risk events, because it, does offer that support as a real asset. Second is around kind of, we're in this environment where you can clip pretty good income, looking at where some of the yields are. So I think it's really about kind of seeking that fixed income type of income opportunity in this type of backdrop.
Thank you, Laura. Thank you, Omar. That was a fascinating and an enlightening discussion. I thank you for being here and for giving us your time. And for those of you at home, thank you for joining us. We hope you took some pearls of wisdom from our esteemed speakers. And from us at Satrix and BlackRock's iShares, we hope to see you next time as well. Keep well.